Real estate investment practice problem using OneNote. Price level adjusted mortgage or PLAM. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down in the 5140 Price Level Adjusted Mortgage PLAM tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations also in the text area, same name, same number, however, with transcripts. Transcripts, they can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at another loan type, which is a variation from the standard 30-year fixed type of loan. The standard variations that we've been looking at are the adjustable rates, where the rates are adjusting. This is going to be different in that the rates will not be adjusting, but instead we're going to be adjusting, in essence, the balance in accordance with inflation estimations on a period-by-period type of basis. Same concept in that the lender, in essence, is putting more of the risk of changes such as inflationary time periods or rates going up in the future onto the borrower, which could result in more favorable type of terms given the lender has less risk, but it's going to be done so in a little bit different of a fashion. Instead of the focus being on the rate, the focus then being on this inflation calculation and adjusting the balance on a periodic basis. This is not as common of a type of loan, but it does have its kind of pros and cons, and it's useful to be aware of and be able to compare and contrast those pros and cons to both the standard 30-year fixed, and if you were to compare it to like a rate changing type of format, an ARM type of format, you can look at the pros and cons there. Note that one of the major kind of differences would be if the rate changes substantially from period to period, it could have a substantial impact on the payment from period to period. Whereas if you're looking at the loan balance changing, then you might have the loan balance could actually result in it increasing, but the payment might be a little bit more constant, at least for a certain range of time periods. And we'll look at what will happen, in essence, to the range of payments and the loan balance with our practice problem here, so you can get kind of an idea of that as well. So remember, you always want to compare to the standard kind of 30-year fixed when you look at these variations. So this would be the standard. We're taking the loan, $100,000, the 30 years, 360 payments, initial rate at the 10% payment calculation, then with the PMT function at 877.57. Then if we look at our amortization table, we would have that 878 about payment all the way through 360 payments, the interest and loan reduction using the 10% rate, resulting in interest going down, loan reduction going up, and we finally fully amortize the loan, nice and neat, at the end of the time frame, 360 periods down to zero. Let's see what will happen then if we do the second scenario. We've got our home value at the 100. We're not going to put anything down because we just want to really focus on the loan here, which is the 100,000. We got the years 30, 360 on the months, and then we have the initial rate at the 4%. Everything's the same so far. That rate's not going to change, but the lender's going to be taking some of the risk from them, putting it on the borrower. If we're the borrower, taking on the risk with this kind of inflation adjustment that we're going to be putting into place. Meaning on a periodic basis, we're going to look at it on a yearly basis here. They're going to use some kind of calculation for the increase with regards to inflation, a calculation which we would have to agree on before the loan takes place, and then basically apply that to the loan balance. So the rate stays the same, but the loan balance will be adjusted, typically increased by inflation. Now, a quick recap, what is inflation? How does inflation play into this whole equation? And inflation is going to be the decrease in the value of the dollar over time, which means basically if you're paying back the loan, of course, in decreased dollars, then the loan's got to take that into consideration. Now, inflation will typically be a factor, meaning we generally have inflation, not typically deflation. Deflation is typically considered bad from an economic and policy perspective, and therefore the government, we're thinking mainly the U.S. government, but governments in general here are going to say they want inflation. Usually in the U.S., they're shooting for something between like 1% and 3% inflation, which they think will be stable enough that we can make decisions on and hedge the risk of deflation, which could be problematic to the economy and be something that we can take into consideration. So we would think then under normal conditions, there would always be some kind of inflation that would be involved. The question is, how big of the inflation is there? The government always is trying to shoot for it to be somewhat constant because they would like to have a steady inflation around that range, but it can get out of control. It has in the past, and it will almost inevitably get out of control at some point in the future. And so it could be higher at some points in time. So the idea then would be that the lender would take some of that burden of trying to estimate what's going to happen in the future, not through changing the rate, which would be impacted by inflation and possibly other factors as well, but instead by adjusting the loan balance periodically, we're going to say yearly. That means that as time passes, we will know what inflation is, or at least what the calculation is on it. No one knows exactly what inflation is because the government is even kind of trying to estimate or calculate what it is. But we'll agree on some kind of calculation that we will apply periodically in the future. And as time passes, we'll simply see what happens, apply out that calculation, adjust the loan balance, and then adjust the payments accordingly based on it. But if you're going into the loan beforehand, just like with an ARM or adjustable rate, we have to kind of figure out or guess what's going to happen in the future and think about a best case and worst case scenario and so on in a similar fashion. So we could do that by estimating like a one rate, which we're going to say 6% here of inflation, which is probably higher under like good times of what the Fed would want for inflation, but we'll guess at basically 6% through the life of the loan to give us a nice round estimate. And then once it's set up, you could adjust this rate to whatever it should be if you set it up in Excel properly. But you might get more complex than that. You might say, well, I think inflation is going to increase by 3% for the first 5 years and then increase more over the next 5 years. And once you see how this is constructed, you can account for those kind of scenarios as well, taking it into consideration. So let's see how this would work then based on that information. We got our same kind of loan structure, meaning if we had the 4% that we start with, we can set up our amortization table, which would be the $100,000 amortization table on the loan. We have the payments calculated based on the 4%, which would be the 477.42 in this case. Interest rate at the 4%, it would all work out, and we can plan it on down. But at the end of each time frame, we're going to update the loan amount. So it's going to look something like this. We'll have the first payment, 477.42, and then we'll figure out the ending balance. This would be the balance before adjustments, which you could figure out with a formula, which we'll do here, and we'll also do this in Excel, or you can construct the amortization table and see it would be this ending balance here. Now, we've adjusted it. Before the adjustment, it was 98,239. And then we're going to go in and apply the adjustment, which is a 6% increase for inflation. So whatever this balance is, whatever it would have been, we're going to say 98,239 times 100% plus 6%, or 106% would give us the 104,133. So we're always going to increase the ending balance by the amount of inflation. Now, note here we have this interesting situation where the rate is less than the inflation amount. That may not always be the case, right? But generally what's going to happen is you get this weird kind of activity on the loan balance. It's actually going up here. So even though we paid it off, it's going up in balance. And as we go through this calculation, it's going up, up, up. And then because we're forcing it to go down at year 30, it's at year 30, it's going to go down at the end, but the payments are going to have a kind of a funny structure it's going to have an increasing payments as time goes. So we'll see how that looks in terms of a graph shortly, but let's just focus in on the calculations here. So that'll be our basic idea. Then we're going to calculate the payment down here based on the new balance, which is going to be that 104.33. So we didn't change the rate. The rate stays at that 4%, but now we changed the balance based on an inflation rate of the 6%. Again, this inflation rate, we're assuming the same all the way through the loan. If the loan actually went period by period, the inflation rate would, of course, vary and depend on what actually happened on a year-by-year basis. So then we have to make these adjustments, once again, on a yearly kind of basis. So let's do this in a little bit form-by-form kind of fashion. Notice if I scroll all the way down, this is like the end result. The orange items represent us basically updating each of the end of the years due to inflation. And we do end up at the end of this amortization schedule with it basically working out to ending at 0. So we don't have that funny scenario where we got that negative amortization that doesn't resolve itself at the end of the loan term that we got when we had the adjustable rate and the payment cap. So let's look at it in a little bit more detail. The payment calculations would be the same kind of thing in our table that we've seen before. So here's the table down below. Payment calculation would just be payment. We take the rate. So the rate would be the fixed rate now, that 4%. So that's absolute reference because we're not changing the rate, divided by 12, comma, number of periods. We're calculating at 30. That's what the L5 is here. It's absolute because we don't want to. Then we're minus 3, which represents this 1 plus 1. So we have that same kind of scenario where we're taking 30 minus 1 plus 1. Why? Because it still represents 30, but when I copy it down, then it'll be 30 minus 2 plus 1, or 29. So for formatting purposes, for ease of copying down, that's why it's structured that way. Times 12 to get to the months, and then comma, the present value is going to be the prior balance, which in this case was the starting point of the 100,000. Once we then get that, we can copy down the payment. But remember, we have that same staggered relationship from, let's see it down here, the payments and the ending balance. So you can copy down the payments. You'll see a lot of zeros until you calculate the ending balances, and then they'll all populate together. So if we were to copy it down, the next payment calculation would be the rate, and that would be the number of the rate would be the same rate because the rate did not change. That's why you have the same cell divided by 12, comma, number of periods in years. L5 represents 30 from the data set, therefore absolute reference, minus N4, that has changed. It went from 1 to 2 now, plus 1. So in essence, we got 30 plus or minus 2 plus 1, or 29 years, times 12 to get the months, comma, the present value then represents the prior loan balance, which is going to be, in this case, the 104, 133. We'll calculate the loan balances shortly. Again, we can copy that down, getting, in essence, our payments in our schedule. So then if we look at the balances, we're going to calculate the balance, and then once we calculate the balance in this calculation, then we'll figure out what the adjustment will be with regards to inflation. That's how we can construct our table. We can get this balance either with a formula like this, or we can do it step by step in the amortization table as we construct the amortization table, and then apply the inflation, which we're going to assume 6% increase from whatever this balance ends up being. So we're going to say, if we're going to do it this way, I think we're doing number 2 first here. We'll say the ending balance is the rate, which is going to be, once again, the same rate. That's why it's absolute reference. I believe it was 4% from the data, comma, and then bracket, this is the future value, the rate, then divided by 12. Rate divided by 12, giving us the monthly rate, comma. Then we've got the 12, which is the number of periods. So if this is for the first one here, it would be starting from the 100,000 from the prior balance, and then we would have the 12 periods out at this payment to get to this amount. That's why it's 12 periods, 12 months, comma, and then the payment is going to be the negative amount of this payment right here, the 477. I'm sorry, that's not negative. The last portion, the present value, would be negative of the prior balance, which if it was the first one would be the 100,000 right there. Now in the second one, same kind of thing. If we copied it down, future value, then the rate L7, getting that from our table, 4% divided by 12 to get the monthly amount, comma, number of periods, once again 12, because we'd be going 12 months from the prior period, and then comma, we got the payment calculation, which would be the payment on the left-hand side, and then comma, the future value or the present value needs to be negative, and that would be negative of the prior balance that we would have going into it. That would then give us our ending balances before we make any adjustments to them. Now remember, these ending balances are going to be dependent in part to the adjusted ending balances, so we can copy them down, but they will still have that staggered kind of effect until we then calculate the adjusted ending balances here, which will be the next step in our table. So now the next step in the table, once we have the ending balances, we can calculate these basically one at a time and then pick up the adjusted balance. In our case, we're saying that the inflation is simply going to be 6% that we're estimating each time frame. So we can multiply these times 106% to see the increase. So the 98,239 times 1.06 would be 104,133. And then using that 104,133, we can calculate the payment using our payment calculation. And then we can see what our ending balance will be based on that information. Once we have the ending balance, we can then adjust it for the inflation. So then we're going to take our 102,191. It's going to go up by 1.06, getting us to that 108,322. Once we have that number, this calculation on the payment should populate automatically because if we copy down that formula, then the ending balance, if we copy that down, will populate automatically. And then, of course, we can copy this one down too. But then once we have that number, we can then figure out what the ending balance will be. And we could do that with a formula that we can copy down as well, which would be the 106,179 times 1.06, and so on and so forth. So we're just figuring out the ending balance of what it would be, and then adjusting that ending balance, increasing it for the inflation, which we're assuming to be 6%. So you can actually construct this nice, basically, table and get a year-by-year summary of some of the data, and then it'd be nice to put it into an amortization table so we could see what it looks like in terms of the full 360 time frames. To do that, let's do it. I'll do it one by one. We won't do all 30 years, but just to get an idea of it. If we start off in year 0, we got the 100,000. We got the 477 at the payment amount that is calculated. At the end of the year, then, you can see we get down to the 98,239, just like we have in our table here. That amount, then, is the amount that we increase by, in our case, the 6%, the amount of the inflation. So down here, same table, that's the increase to the 133. So we actually went into the amortization table and just adjusted it up by the 6% increase. And then we do the same, so that matches the table. We could do the same thing. Now the rest of the table, if we just left it that way and we copied it all the way down after that, after that adjustment, it's still, well, if I copy it all the way down each period, it'll still kind of work out. So it still works out to 0. So you got that kind of nice balancing type of thing. Now, if we look at the second payment, so now we've got the 104,133, then I would need to take that number and calculate the next payment based on that new balance, the 104,133, which would be 506,06. That's the new payment that we calculate there. If we add that payment and left it as is, that's when we're back in balance after making that first adjustment. If I go all the way back down, we're back in balance at that point in time. And so it kind of works out that way, which is kind of nice. So then we've got that amount, and so that at the end of year 2, then we're at the 102,191, just like we see in our table here, which we need to then adjust from 102 to the increase in 6% to the 108,322, as we see in this table. So we adjusted it right here to the 108,322. So now we've done the 2 years out at that point. Then if we go all the way down to year 3, just to continue it a couple more times, one more time at least, we're going to say now in year 3, we have to adjust the payment based on that 108,322 to the new 536.42. So it's about 536 in year 3. If we copy that all the way down after having changed this to 108,322, again, we should be back in balance because we calculated the payment based on that new amount. So that's kind of nice that it works out that way, but we got to do that each step. So that would be the one. And now we got year 3. At the end of year 3, we're at 106,179, which is this amount, which we would have to increase by 6% or whatever the inflation is, which we're guessing to be 6% to 112,549. So we could see that here. There's the 112,549 that we would adjust for that time frame, and so on and so forth, all the way down for the entire loan. So if we did that 30 years for the entire 30-year time period, which is tedious to do in Excel, so we do this in Excel. It takes a little while to set that up. But once you're set up, then you can then you can go in and practice it. So you can see each year we calculated it out, then we adjusted the ending balance, and then we adjusted the new payment based on that ending balance, got to the end of the year, increased it by 6%, then calculated the payment based on that 6%, got to the end of the year, we adjusted it for the 6% increase, then calculated the payment for that next 12 months, got to the end of the year, adjusted it by a 6% increase, then the new payments for that year, and so on. And you could see that same pattern that would be adjusted down for the life of the loan, and we would actually get to the loan balancing out after the 30 years, but you do get kind of an unusual kind of payment structure that does take place. So you can also calculate the flow kind of assumption with this nice little table that we constructed, which you could do this fairly quickly. It's quicker to do than the amortization table. And you can get a pretty nice little flow calculation, meaning you've got the money that we got from the loan of the $100,000, and then you've got the outflows that would happen if we look at it on a yearly basis. It would simply be the outflow of the 477.42 each month times 12. That would be the 5729. The second one would be 506.06 times 12. So we got a yearly amount of an outflow of 6,073. If we take that all the way down, we can calculate basically the total down here, summing it up, and then we can calculate the IRR, the rate at which that series of payments would be 0. Now this IRR is kind of like the effective rate calculation, meaning we're kind of rolling in, the costs of this inflation that was rolled in. So obviously the rate is not really 4% that we're looking at. If we looked at this whole thing, it's closer to like 9.66%. So that's the rate that you can use possibly kind of as a comparison. Although again, that rate of course will change as we have different places possible, or it could change different places possibly in the amortization table, and or if we assume different inflation amounts. And of course, this is based on an assumption that the inflation is 6% throughout the entire loan term. So you can have different what-if scenarios based on that. Now, if we go, let's take a look at basically a graph down here. It's kind of interesting the way this is working out in terms of how the payment structures happen. Remember here we had the scenario where the initial rate is lower than what we assumed the inflation rate would be. So you would assume then we're paying, we might be paying less than we would need to kind of cover the increase in the inflation rate on the loan, but we're still adjusting the payments each time period to equal out, to get down to 0 after the full time period of the 360. So you end up with this situation where the loan balance is actually going up, all the way out over here, as you can see in our payments, right? The loan balance increasing until it starts to decrease right around here on like period 18, and then it goes back down, right? So you got that kind of funny structure. So obviously you got to take that into consideration. If you're comparing to other kind of loans, how long you're going to have the property, what's going to happen to the balance. This will not be as extreme if the interest rate was lower than the inflation rate. So if the inflation rate was like 2% or something like that, you could graph this out. And we do have this in Excel. So if you want to test this out with different inflation rates that you would assume, these being constant rates that we're assuming here, then you can graph that out. You could take a look at it. But you get that kind of funny. So what happens to the payments as comparison to that? Because as the loan balance is doing this, we're calculating the payments to still end off after 30 years. So you can see there's actually this increasing rate of the payments. So the payments are going up, not only going up, but they're going up at an increasing rate, right? Because of that inflation rate that's happening. So again, that's a kind of a interesting structure in the payment structure and how that's taking place. And you can compare that kind of to a rate if you're talking about an adjustable rate type of loan or something like that as well. You can kind of compare these out to an adjustable rate. So that's based on these payment structures here. We did the IRR. You can also, of course, add a pivot table and do your IRR calculations based on the cash flows as well, trying to assume what would happen if I held it for 30 years versus what would happen if I held it, say, for only 5 years or something like that. So if we did our 30 years IRR calculation, we'd have the outflow of the 10 or the inflow of the 100,000, then the outflows, which are adjusting on a year by year basis after having adjusted the ending balance due to the 6% inflation that we assumed, and we get to the rate at which this would be zero would be the 9.67. So after this whole thing is over, 9.67. If we did it for 5 years, the IRR for 5 years, we got the 100,000 outflow, 60 months now, 5 years. We looked at and that ending last point represents that ending balance. We're looking at it after the adjustment, 1221039 plus the last payment 603. That's where we're getting the 121,642 we'd have to pay off. The rate at which that series of payments would be zero, 9.675. So that's pretty close to what we got here, 9.66. Remember that this calculation that we did up top on a yearly basis is a bit of an estimate, given the fact that these cash flows are assumed to happen at the end of the period, in this case, the end of the year, when in actuality they happen in 12 equal payments. So it's a bit more of an estimate here, but you see it's a pretty good, idea of what we're looking at on that. So then, obviously, you can take this information as well and add the pivot table, which I won't go into in detail here. We've seen it a couple times in the past, but that can give you that year-by-year breakout, which we kind of put together when we constructed this thing, a pretty good little year-by-year breakout. But this one would include at least the interest calculations as well, which could be useful if you're doing things like tax calculations on it too. So it's useful to have the pivot table to be set up. So if this is something you're interested in, you can see how to kind of calculate this in Excel. We put this together in Excel. We also have this worksheet in Excel. So if you want to use this worksheet, if it would be useful to do kind of estimates with, you can use it for that purpose as well.